Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 19.17% year to date. We are beating the returns of the S&P 500 buy and hold investor. Their portfolio is up 18.27% year to date. So both portfolios are actually doing very well this year. We have a green for the stock market strength color signal. Last week, the S&P 500, we use the ETF SPY, and we call it the spiders. So we use the spiders for all of our charts, basically. And the spiders, or the S&P 500, gained 1.41% last week. Now, we do have a negative divergence that we've had on the charts for some time. And as a result of the crest at this negative divergence here, that's when the S&P 500 experienced a 9.5% correction. Or pullback. That was the last reasonable pullback that we had, other than about this one here, which was about 6%, and then 10% prior to that. So this is where we currently stand. Now, because the low of this pullback took out this high here and a little bit of this structure right here, it kind of gave the impression that the market was softening and weakening up. As a result of how much the market declined, kind of gave the impression that there was going to be a little bit more softness coming up here in the future. So this negative divergence still hasn't worked its way out. The MACD is still negative, but the slow stochastic here on this weekly chart is positive and heading up towards 80. We made no trades last week. Here are the trades that we've made in calendar year 2024. We currently have 2 open positions in yellow. So we do have 200 shares of SPY. We purchased that a while ago. We've been in this trade for 208 days, and we are profitable by 15.25% or $14,876. We also have 1 in the money covered call, which is 100 shares, and we have a strike of 395, so we've got pretty good downside protection here for this. Now, because I price the portfolio as if we're going to close it out today, then I have to put in the price of the position today. Now, we're not going to, so that shows that we're upside down on this in the money covered call by $786 because the market has advanced. In reality, I'm not going to close that out at a loss. I'd rather just let it expire, let them take the shares away from me and have no loss in the portfolio. So in reality, we're not going to take a loss on this call position, but I do want to put that in here as if we're going to price it out as if we're going to close out the position. Now, here is our model portfolio in blue on a percentage basis compared to the benchmark of the S&P 500 in pink. And you can see that we are slightly beating their portfolio, but both portfolios, you mean anybody that's getting an 18 or 19% return and on a whole year, that's a fantastic annualized return. Now we're looking at a 6-month daily candlestick chart of the spiders. You can see the drop that we had here and the correction. Now I put in here in this red line where the 78.6 fib is. And on this line, on this candlestick right here where I've got the arrow pointing towards it, that is when I decided to sell an in the money covered call, and I bought to close. I should have said I sold to close 2 long calls right here. So we did have 2 long calls, and I sold them for, one was actually for a profit, one was at a loss, but overall they were for a profit because we hit the 78.6 fib. The market had showed that we had taken out this high and this structure right here. It looked softening, but that rebound, and it still continued. It was an incredible rebound. And we've still now we're kind of bouncing around. Are we going to take out the old high is now the big question, or are we going to begin to soften out? Now we're looking at a ratio chart of the NASDAQ 100 to the S&P 500. And this chart is showing risk is stuck in a trading range. So this gives us an idea of what risk on and risk off. Generally speaking, when this ratio chart in red and black is traveling north, that's a risk on position. And the S&P 500, which is in dark blue, also travels north. But now we appear to be in this trading range between this low end and this high end. And if we are going to bounce around there, the S&P 500 will probably bounce around in that area as well. The MACD, you can see here, has softened on the histogram, has also changed its trajectory here, and the slow stow has already crossed over. Now we're looking at the VIX volatility or fear index. There are three ranges. The upper range, which is completely bearish, the low range, which is bullish, and the ultra low range, which is below this green line here, which is also bullish. We are right at the tail end of, or right at the top end, I should say, of the ultra low range, which is bullish from this perspective. MACD is softening, coming down, slow stow below 20 and just kind of hanging out there. So these signs suggest that the S&P 500 is going to move sideways to up. Now we are looking at a seasonality chart. We are currently in the month of August. For the month of August, going back 5 years, there's a 40% probability that you're going to close the month higher than when you opened. Currently, the S&P 500 is up 2.6% for the month of August. There is one trading week left in the month of August. You have a 40% probability that you're going to stay green for the month of August, at least going back for the last 5 years. That tells you that you have the potential of losing 2% in the S&P 500 over the next 5 trading days. All right, now we are looking at a 3-year weekly chart for the spiders. So each one of these candlesticks represents 1 week's worth of data. Let me just pull the drawing down a little bit here so you can see it a little bit better. And what's happening is that you've got the cycle brackets, and let me just point them out to you right here. So you've got cycle brackets here, here. These are actually the low points that I'm showing, but the cycle brackets are actually here and here. Now this low represents that low, this low represents that low. This low over here is undetermined right now. It's somewhere coming in over here. So this is the unknown area. What is this market going to do? You can see how close the current market is compared to the old highs. I mean, we're just a stone's throw away from breaching the old highs and getting back 100% of the Fibonacci retracement of this 9.5% pullback. So we are very, very close to making that happen. We also have what's called the VTL. That's this line right here, grabbing it from this cycle low here to this cycle low here, drawing a line from that low to that low, straight across, and look where we are. We are now trading above the VTL. So generally speaking, here's my notes for today, August 24th. We are bullish as long as we stay trading above the VTL. So you know what my current positions are. I showed them to you earlier in the presentation. Basically, I'm going to hold those positions for right now as a result of what I'm seeing. So going long right now, or staying long, I should say, is not a bad position to be in. Are we going to grind higher? Now, I also have in here standard deviations. +2, -2 in pink, +1, +1, +2 and -2 in gold, +1 and -1 in pink. Okay, sorry about that. Let me just clean this up and make it a little bit cleaner. So what's happening is that we are trading right there, which is about 1.4 on the standard deviation chart. Generally speaking, you are going to trade 68% of the time between the +1 and the -1. 68, or you might as well round it, 70% of the time, you're going to trade in between these two. Then the +2 and -2, you're going to trade in between there and there 96% of the time. So the closer you come up here, the more probability you have that this +2 standard deviation is not going to be breached,
you're going to bounce, and then you're going to come down, and then you'll ultimately reach this cycle low somewhere in there. We just don't know exact. That low has not been set, so that's still an unknown variable. But that is what could happen in this chart. I do have in this chart where I had a target range, and we sold over here in the upper end of this target range, taking in that in the money 100 shares, one contract for an in the money, giving us some downside protection. So if this market does begin to pull back and you start doing one of these things and you find a support somewhere and then start bouncing, well, then what we'll end up doing is we'll buy to close that in the money covered call for a profit, and then get those gains as they go up, especially if we're getting near this cycle low. Depends on how this all unfolds. So we're going to see how that plays out. Let's switch over to a daily. So let's go from the 1 week already. Let's go to the 1 daily there, 1 year daily, and let's switch over to the daily cycle brackets. And it's a little clumsy. Let's just bring that down so we can see that a little bit better. Okay, now in this chart, I've got two valid trend lines. This valid trend line here, and this other one, which is a different valid trend line starting from here. Actually, hold on one second. Starting from here, and then grabbing a low point there and coming over here. It seems to be trading in between these two valid trend lines right now. So that's what's happening. I also have in here that target zone that we hit right there. And you can kind of see everything pretty good here. Here you can see where we had a cycle breakdown or a negative cycle, because we had a low, and then when we came through to the cycle, this low is lower than that low. So that is a negative cycle because it went down lower. That's what gave me pause or hesitation in order to be completely long, feeling not confident that we're going to take out this 100% retracement. But I did feel, so that's why when we hit the 78.6, I started taking those profits, banking those profits. Now, does that guarantee that we're not going to continue to advance? No, absolutely not. We absolutely can continue to advance. And the market is so strong, it's just going to keep going up. Now, when it comes back down, I'm going to give you an example right here. So here you've had a negative cycle because this cycle low took out over here, let's say this cycle low right here, okay? So if we're going to mimic the current cycle that we're in, we're going to mimic ourselves after this cycle, the cycle after the negative cycle. So there's the negative cycle. There's the negative cycle low corresponding with that low. We are now in this cycle, which corresponds to this cycle. And where are we at currently in this cycle? We are right about here. Because we still haven't taken out that high, which is this high right there. We're close to it, but we haven't taken it out yet. Now, it doesn't mean that, like it did before, it took out the high, then actually had a cycle high, and then came down to a cycle low there, corresponding with that cycle low. So your buy point on this cycle is right there. We don't have that low established yet. So we want to see, first of all, if we're going to take out this 100% right there, we want to know if we're going to take that out. And if we are, we want to buy the low, and then once it bounces, once it stops going down, I should say, that's when we want to change our position to a much more bullish tone. Now we are looking at a spreadsheet that I created in an effort to determine the health of different various asset classes and the 11 sectors of the S&P 500. So basically I put a green on everything that totals either a 5 or a 6. So the more green on the screen, the more healthier everything is. And there is a ton of green on the screen. Another thing you want to do is you want to compare last week's reading to this week's reading. And last week for the 11 sectors, they were actually the same, 83 and 83. But across various asset classes, we went from 76 to 89. So things are strong for the market right now. I mean, for definitely various asset classes for sure. And the market is healthy at an 83%. Now we are looking at a chart of the 10-year Treasury yields. That is the candlestick chart. In dark blue, that is the S&P 500 spiders. And then in black, solid black, that is TLT, which are 20-year bonds. So basically, what's happening to the 10-year yields? They're in a trading range between this upper end and this lower end. The market is fine. The S&P 500 in dark blue will advance if as long as the rates stay within this trading range, which they appear that there's no real energy to take them out of this range right now. So from this information, that tells you the S&P 500 is going to go sideways to up. All right, I just gave you guys a ton of information in this presentation. This is the intra-month video where it's shortened, where I give you a condensed amount of information. At the end of every month, I give you a full video, which gives you much more deeper dive into all the various things that we look at to make our investment decisions. So with the information that you have right now, now comes the critical thinking. What are you going to do with that information? Well, as of August 24th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now, I am only holding one in the money covered call to allow some downside protection. I showed you the call that I have right now. It'll take into account about a 10% decline, and it has an expiration date at the end of October because of the summer doldrums, August, September, and October. After that, the November and December, the market is looking for, seasonality-wise, more positive. So we don't want to have in-the-money covered calls during the months of November and December. So I already have 100 shares protected, but I'm capped on how much I can allow that to grow. That's why I left 100 shares naked with nothing on it. The market is very close to all-time highs, and there's only 1 week left of trading for the month of August with a 40% probability, going back 5 years of data, I showed you that, for a positive month. That means that there's a 60% chance that you're going to have a 2% correction in the next 5 trading days. And the following month, September, is a very weak month. Now, right here is the seasonality chart. You can see for the month of August, September, and October, how basically these are weak months. And then when you come into November and December, how you have 75% probabilities of closing the month higher than when you open the month. This is the seasonality chart right here. So this is what I'm thinking. I will most likely take one more in the money covered call with a September 30th, 2024 expiration and a 510 strike. And they're going to pay me $54.96 to sell this covered call. This is what the actual transaction would look like on the Thinkorswim platform. I'm selling, that's why there's a negative sign here, one contract, 100 shares, and it's going to be with the strike expiration date of September 30th, 2024. There's your 510, and it's a call because I'm selling an in-the-money covered call. They pay me a premium, $54.96. Well, when you take the current market trading price for the spiders of 562.13, you subtract out the strike, that equals $52.13. That's the intrinsic value. That's the value that is baked, that they give you because the market is currently higher than your strike price. So they're going to give you an intrinsic value, but they're also going to give you an extrinsic value, in this case, $2.83. Well, even on a worst case scenario, all I get out of this trade is the extrinsic value of of the profit. Why? Because the only reason I would get that is if the market continues to advance. If the market continues to advance and doesn't have any pullback, well, then I'm going to have to just wait until September 30th and just wait till the contract expires. They call the shares away, and that's it. What am I going to get? I'm going to get $2.83 of extrinsic value for the 35-day trade. On an annualized basis, that would equate to a 5.82% return, which is very low. It's a low return, but I'm just taking on a 35-day trade for the 100 shares. It gives me 10% downside protection. There is a 40% probability or 60% probability you're going to close lower. And then in September, for the last 5 years, every single month has been negative. So what am I thinking? I'm thinking that between the last week of August and for the month of September, there's going to be a minimum of a 2% decline between that time frame. And there's quite possibly going to be a lot more than 2%. And by having these in the money covered calls that I am talking about, well, that's going to give me that protection. So basically, I'm going to be sitting on the sidelines waiting to see if this market is indeed going to pull back. And if it does, that'll be good for me because of the way that I'm positioned. Unless, of course, the market has, let's just hypothetically say, a very strong, I don't know, let's just say 20% decline. Well, in that case, I would buy to close it when it reached 10%, and then I would put on another call 10% lower. So I'd have to adjust my position and roll out if that was the case. But that we're nowhere near that. That's probably not going to happen. Probably won't even be a 10% pullback. But let's just see what happens. These are unknown variables. What is going to happen for the last week of August and for the month of September? Are we going to stay with this historical norms? I'm putting my money in a position where I believe the odds favor this type of a transaction. And even on a worst case scenario, I'm still not going to lose money. I'm just going to lose out on future gains if this market just continues to grind forward. I'm going to lose out on those advances. That's the worst case that can happen to me. But it's the summer doldrums. We'll see what happens. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.